Gromen, founder and president of FFTT, Forest for the Trees. Happy Sunday evening to everyone. Hope everyone had a great weekend. Two things that grabbed my attention recently. First off, in my opinion, so far it's tough to read too much into what we've gotten out of the G20 meetings, and in particular, that between China and the U.S. Two things grab me out of this. Number one, the U.S. effectively appears to be saying you need to reduce your trade surplus by buying more real stuff from the U.S. And the interestingly, they're not saying you need to buy more treasuries or you need to start buying treasuries again, maybe more apropos. The implied change in flows is pretty critical and implies a weaker dollar over time. That said, in the near term, if the U.S. starts exporting more to China, obviously that will soak up more offshore dollars and ultimately be dollar positive in the short run if everything else is equal. And so that'll make goods less competitive. That will weaken the economy further. That will continue. So you're in sort of this vicious cycle. In theory, this positive will increase the vicious cycle of stronger dollar, higher rates. Ultimately requires the dollar to be weakened via structural change to the dollar's reserve status, and that change is arguably, looks like it's being made on some level with central banks buying gold, selling treasuries, but hasn't been marked to market yet, and those changes won't matter until they matter. The second thing within that grabs me between the U.S. and China is that, to me, I'm reticent to say that they accomplished too much, because ultimately you're still in a situation where it's a matter of national security for China to be able to print yuan for commodity imports, and it's a matter of national security for certain interests in the United States to not allow China to print yuan for commodities. And that's pretty straightforward why. China will have a balance of payments problem if it can't gain the ability to do this. The United States will have a balance of payments problem if China does gain the ability to do this. And this weekend does not change that at all. And so I expect more headlines and stuff over the next 90 days in terms of the quote-unquote truce, but let's see how that goes. Second thing I wanted to highlight, something I tweeted over the weekend, or retweeted, I believe from my friend Jesse Felder, was that Ned Davis Research Global Recession Indicator, now very much in a danger zone, at a level last seen in late 2015, in late 2011 during the EU crisis, and before that seen in late 2008 during the Great Financial Crisis. Not exactly sure what goes into the indicators, but I know those guys at Ned Davis do great work. Thought it was an interesting thing to highlight. And bottom line to me is that it's yet another piece of evidence to me suggesting that the Fed is likely closer to blinking than most think, particularly, or which is interesting even as the long dollar positioning is as extreme as it's been in 2+ years. So we'll see how it goes, but those are the two key things that kind of grab me at this point. Happy to take questions for a few minutes if you have any. Let me know. Jump on and ask a couple quick questions while we're waiting. Of course, check out FFTT-LLC.com for some of the things we're up to lately. Learn more about our tree rings product if you're interested. Also, actually going to have a new book coming out soon, which you'll be hearing more about, I suspect, and we'll be talking more about that on the website. But at any rate, let me know if you have any questions here. Let's see, so far nothing. Might be a little bit of a lag on our Wi-Fi, I'm told, or not on our Wi-Fi, but on our direct link here. Oh, there's one. Hi Garrett, do you think the Fed will not raise rates in December and that is positive for gold? No, I think the Fed's going to raise rates in December. I think they're sort of committed to that. But I do think that you're going to see meetings after that. I think you may see a change in language. I think you may see a change in tone. I think the language will start to change pretty quickly after December. Let's see here. What else do we have? Let me go back up here. Okay, perfect. When should we learn if the Aramco China oil deal is priced in renminbi? Great question. Hi, Craig. My guess is it may not. We're going to have to need to watch markets, I think, for hints of how that deal is priced. All else equal, the way oil markets traded in, oil and currency markets for that matter, traded in October would suggest that it at least has optionality in that direction. By that I mean you saw the gold-oil ratio blow out from, call it 15 barrels an ounce to 25 barrels an ounce, with a driven almost entirely by a collapse in oil in October and into November. You saw the dollar strengthen and the renminbi weaken. Those are also things you'd expect to see if that's happening. But I think we're going to need to watch that going forward and see if we get any more explicit indications on that. Let's see. Seven McCaw. Hi, Seven. You often reference the concept of a severe dollar shortage. As someone fairly new to your work, can I provide some context to the idea? Yeah, the way to think about this is ultimately the world has borrowed a lot of dollars, and when you borrow it, that is sort of finance 101 way of shorting the dollar, right? You need to earn the dollar back to pay the dollar back with interest. The world has done that. The U.S. corporate sector has done that. The U.S. government has done that. Everyone is short these dollars. And with that is the sort of the very basic overlay of why the world is short dollars. If the economy slows, dollars become less available, and so basically you're into a game of musical chairs where there's more demand chasing fewer dollars, and you get a dollar short squeeze, a liquidity short squeeze. Within that, you have sort of this, the Eurodollar system, the U.S. system. Eurodollar system is effectively an offshore dollar system. Where foreign banks create dollars that they don't have via these loans, and so it's an interesting system. It's been in place a long time. You're basically talking about a system with infinite leverage, but ultimately that's basically what we're talking about. A lot of people have borrowed a lot of money. It's denominated in dollars. They need dollars to pay it back, and those dollars are getting more scarce. Hi, Mike. Can I elaborate on the gold-to-oil ratio? Yeah, ultimately, the gold-to-oil ratio is simply a metric of the health of the petrodollar system. A low gold-to-oil ratio is a healthy petrodollar. That low gold-to-oil is low gold price, relatively high oil price. Low gold price keeps less competition for the U.S. Treasury bonds as a primary reserve asset, and relatively high oil price in the denominator creates U.S. dollar surpluses that are then recycled ultimately back to the U.S. As the gold-to-oil ratio rises, whether it's by higher gold or lower oil, you can see obviously a much higher gold price to drive gold-to-oil ratio higher. When gold rises, that's competition for the Treasury for Treasury bonds as a primary reserve asset globally. And obviously that communicates information regarding the dollar specifically, as well as other fiat currencies, but the dollar in particular. And then oil in the denominator. If oil's falling, obviously you're draining the world of the dollar surpluses needed to finance our deficits. And so a high gold-to-oil ratio is a sign that the petrodollar system is under stress, or a rising gold-to-oil, high gold-to-oil ratio. It's a sign. So really think about the gold-to-oil ratio as a temperature gauge of the petrodollar system. The higher it goes, the more stress it's under. Let's see. With the so-called China, hi Mark, will the so-called China deal be market positive? Sounds like thus far it is. Markets indicated up 400 points the last I checked before I jumped on. Will it be going forward? I think if they get something done, if they do the right thing is to change the structure of the dollar's reserve status. That allows us, you move back to something that looks more like pre-1971, except maybe with a floating price neutral reserve asset, whether that's gold or SDRs. Suddenly, the United States can actually compete in a number of different export markets in a real way. Suddenly, other nations that are currently have currencies or running massive trade surpluses, China especially, can have the wherewithal or have the incentive to buy stuff from other places in the world. That's sort of the good scenario. That would, I think, be bullish for risk on a sustained basis. If we don't end up at that point within 90 days, with the 90-day window we have, then I don't think they will have accomplished much, and I'm not sure that it's risk positive. I'm not sure it won't just set us back to where we were before the G20. Let's see. Why is the gold ratio important, or gold to oil ratio important? It really comes down to, if you're pricing oil in multiple currencies, then suddenly the reference point for oil goes back to being the reference point of oil from 1850 to 1973. The reference point of oil was the dollar, but it was backed by gold, and before that, pound sterling, which was backed by gold, by and large. And so, really, gold was a reference point of oil. Gold's the number one asset sitting on balance sheets. If you have multiple currencies competing or pricing oil, that suddenly allows oil exporters to pick and choose which currency they want to sell in based on which currency is more attractive. If currencies have to compete on fundamentals, the currency fundamentals that they compete on are balance of payments and FX reserve balances. And so those currencies with better FX reserve balances and balance of payments would be more attractive to hold or to recycle into. And so basically you move back to the dollar needing to be more competitive, because on a balance of payments basis, the dollar is by far the dirtiest dirty shirt. And so you'd have to depreciate the dollar. Our guess is it would depreciate through a neutral reserve asset, in particular like gold. Let's see. What evidence might we look for to suggest the West will close the gold window to Asian purchases? Hi, Mike. I'm not sure, to tell you the truth. I think we're seeing, the reason I say that is I think we're seeing a lot of that evidence already. You're seeing strain in the paper markets. You're seeing rising paper leverage in the West, in gold markets. You're seeing physical flow in large amounts from West to East. One of my best relationships on the street says all the time, any given Sunday, if you told me, tomorrow gold, they'll close the gold window, gold will be indicated or repriced in the East, or indicated up, or reset higher, I wouldn't be surprised at all. If you told me it took 5 or 8 years, I wouldn't be surprised either. There's a lot of shells they can move around. So it's a tough thing to say this will happen. There's a whole number of different factors. Let's see. What policy changes can speed up reshoring of U.S. manufacturing? I think you have to change the currency, the currency system. If we make these changes without restructuring the dollar's reserve status, all that's going to happen are U.S. rates are going to rise and the dollar's going to rise because we'll be creating dollar shortages elsewhere in the world. And so basically, without changing the structure of the dollar's reserve status back to something that is more like Bretton Woods, all you're going to be doing is making U.S. manufacturers manufacturing less competitive, weaker, and you're going to be making the U.S. economy weaker as rates rise because we arguably have more sensitivity to rates than anybody else. Another question from Mike. Does the U.S. have the means to defeat the S-400? Don't know. I can only go by what I watch, which is the U.S. seems to get very upset anytime anybody talks about buying them. And there's a lot of people very interested in them, despite the U.S. Threatening sanctions against anyone that buys them, which, don't watch what they say, watch what they do. Let's see here. Why is the petro yuan bearish for oil prices? It depends. Ultimately, if oil is priced in dollars and in yuan, law of one price says that you can only that you should not be able to buy oil in one currency and sell it in the other and make money risk free. And so suddenly if you have a falling yuan, which in theory you would, because you're going to be increasing yuan liquidity as the yuan takes share of global commodity trade. So you have more yuan with not a lot of yuan-denominated debt to soak it up. So it's going to put downward pressure on the yuan. That'll put downward pressure on oil in dollar terms. And so that's how we think about that in a simplistic way. Do I think early 2019 will be bullish or bearish for gold, and why? Hi, Garrett. I think we are getting very close to, like I said before, the Fed having to pause and start talking more about that based on what's happening with the domestic economy. two things from that. Number one, if we're right, I think that's probably good news for gold, set par. If we're wrong, then it might be a little negative for gold, but I don't really see it being that negative for gold because basically what you're talking about at that point is the Fed looking to damage the U.S. economy in a very meaningful structural way if they keep going, even with the economic softness we've seen. They will really hurt shale. They will make it hard for the U.S. to increase oil production next year if oil falls another $5 to $10 a barrel. They will hurt housing. They will hurt our ability to compete in manufacturing and reshore. And so I'm not convinced that if the Fed doesn't stop, that it's really bad for gold either per se. But again, in this entire overlay, you've got to do something that I think the thing that really gets gold going is a political decision made somewhere. The gold markets, we have said over and over, are not a real market, and they've not been real markets for at least 5 years. That won't change until it changes, and that's not something we're going to need a hint to see, in my opinion. It's going to be plain to see, and I think potentially spectacular to behold. Let's see. I see you and Brent debating on Twitter. Do you have criticisms of his milkshake theory? He and I have a bet, which is by the end of next year, effectively, I agree with him entirely that the milkshake can last for a short period of time. It is not sustainable for more than a couple of months, and that's our bet, which is to say he thinks the dollar is going to 120. And our bet, in fact, the terms are dollar goes to 110 and stays there for at least 6 months, and the S&P will, in that time, be at will finish at near within 2% of its all-time highs, and the Fed will hike another 4 times. My whole criticism / disagreement is that I agree that that can happen in a short-term basis. However, because foreign central banks are no longer buying our treasuries, it can't last for very long because the United States will crowd out its own economy. And so my view is what we call the U.S. trilemma, which is that you can have 2 of 3 of the dollar rising, rates rising, or stocks rising, but you can't have all 3 sustainably. And I think in the last 2 months we've started to see signs of the trilemma holding. That the milkshake absolutely held for the summer for sure. From call it March to maybe July, August. However, October or September, October, I think we've seen that with what equities have done in response to rising rate, rising dollar. We continue to think that it's simply not a sustainable situation in the manner in which he does. Let's see. Hi, Mike. Harold Malmgren thinks the U.S. has deeper resources to keep the game going. I think he's referring to the Eurodollar market. I think he may think that the U.S. Fed is going to keep tightening, basically blow up the world, blow up the U.S. economy, and see what, basically call in an airstrike inside the U.S.'s own wire and sort of, kill them all, let God sort them out type of a view, to be blunt. I suppose that is very valid, and obviously Harold is a friend of mine. I don't. I know Harold's depth of experience, and he's forgotten more than I could ever hope to know, and so it really comes down to I think some of the political dynamics of if the Eurodollar market breaks, what does that look like for supply chains? What does that look like for supply chains in China? What does that look like for supply chains here? What do those supply chain breakdowns look like in terms of political implications? Right, you're seeing France having some troubles tonight. If supply chains break down because the Eurodollar is or the dollar's at 110 or 120 or 130, which is what would happen if the dollar goes there. That calls into question some other political outcomes. So. I'll leave it at that. A few more questions here, and then I'm going to jump. Hi, Seven. Can I see a scenario where the 10-year Treasury yield actually goes to lower, to say at 2.5? Yeah, I could. I think there's 2 scenarios for that, where you could get You could get an economic collapse where, in 2.5, probably you don't need a collapse, but certainly maybe a garden variety recession. You could do that. I don't think that's going to be good news for equities. It's probably not going to be good news for the dollar either, actually. The other situation you can see is, and where I think this movie's going is I think you're going to get a situation where the Fed is forced to cap 10-year Treasury yields with printed money, growing their balance sheet in order to finance the U.S. government. And I think that's much closer than most people think when you look at the numbers. And so, that's a scenario where, everybody wins except the dollar, right? In other words, rates could go to 2.5 because the Fed says we're going to buy every 10-year you offer at 2.5, no questions asked. That's what they did during World War II, by the way. And the S&P 500 could go from 2,700 to 4,000, and the dollar probably would go down. And so you could, I think that's a scenario where you could see that happen. All right, let's see. I think that looks to be about. It. Oh, hold on, a couple more. Oh, that's it. All right, guys. Hey, thanks for jumping on tonight. It was great catching you all, and we will catch up with you next week. And have a great week. Look forward to chatting soon. Take care.